Okay, so we started recording. So, greetings everyone, and welcome to this workshop session of Trade Pulse. I'm Yashini Bansal, Joint Secretary of the Quant Club IIT BHU. Today, we are privileged to have Mr. Rajiv from AlgoBulls leading our session. Trade Pulse is an integral part of our event Quantstein under the umbrella of TechNext. It's crafted to hone your skills in algorithmic trading and unlock your potential in quantitative finance. As most of you already know, AlgoBulls is an AI-driven algorithmic trading platform offering intuitive tools and cutting-edge technology to empower traders as well as coders of all stripes. Whether you are a novice trader taking your first steps or a seasonal professional, AlgoBulls has the right resources. So, with no further delay, I invite Mr. Rajiv to guide us through this workshop about stock markets and algorithmic trading. Over to you, Mr. Rajiv.
Thank you, Yashini. So good evening, everybody, and I'll start with my presentation uh, with a comment that the topic for today's session is strategies for stock trading. So you all have gathered here for the preparation of the competition that will be held in days to come. And for that, what we thought was that it will be a nice idea to prepare yourself with the background of the business logic about the strategies. So our belief is that if the programmers, if the techies are aware of the underlying business fundamentals of the stock trading, they tend to perform the best in their uh, work of developing of the strategies. They don't have to be given minute instructions as to what is what. So we will try and understand how it helps as we move along. So the first slide of my presentation is understanding of investment and trading. Generally, we use these terms very loosely, in place of each
Excuse
other.
me, sir.
Okay,
So, sorry for interrupting. It would be great if you can turn on your camera.
turn on my camera.
Uh,
One
yes,
second.
sir, if it's comfortable for you.
Yeah, one second. Okay, can you see me here now?
Yes, sir.
Okay, great. Okay, okay. So I was talking about investment and trading. What is the difference between them? So investment is basically for a long-term duration. It could be for a year. It could be for 2 years. It could be even for 10 years. Many of your participants, their parents would be holding some investment right from their first job. Like some of them would have bought Infosys in the IPO or Tata Steel or for that matter Reliance and likes of those, and they are holding on to it, and they have become really a blue chips now. So that's the kind of uh, area where we say that it's an investment. You hold it for a longer duration with an objective of capital appreciation. You don't really buy and sell every now and then. It's essentially for a long-term duration. So usually this investment is based on fundamental analysis of the companies. So when you decide to buy a company, you would look at the quality of the company, its returns over past few years, what is the management philosophy, how the management. Uh, yeah, can you please mute the background noise? Yeah, thank you. Yeah, so you look at the company fundamentals. What are the returns for last many years? What is their debt to equity ratio and things like that. So that forms the investment part. And trading basically is a short-term phenomena. It could be a swing trading, it could be a short-term trading, or it could be even an intraday trading. So swing trading, typically it will be considered from maybe 1 month to 3 months or 6 months. And short-term trading is basically from expiry to expiry. From this expiry to next expiry, whatever we trade, that will be falling under short-term trading. And intraday is typically you buy or sell something today in the morning, and by the end of the day, you cover your position. So that is intraday trading. So each one of that, this type of trading has its own, objectives. Intraday trading is basically for people who don't want to carry forward their position and get relieved from the daily fluctuations. For example, today you have bought something and tomorrow market falls and there is a gap down opening for that scrape, you tend to lose a lot of money. So people, those who do not want to carry forward such risk, they typically get involved in the day-to-day trading or intraday trading. Whereas short-term trading is uh, during the expiry. At the start of the expiry, you take certain position with a view, and you cover that position at the end of the expiry. We'll talk about what is expiry, what is position, etc. as we go forward. But sufficient to say that all these tradings are based on the time period involved in the complete trade. Now, each of these types of investment, whether it is investment or trading, it requires a facility for the investors to screen the stocks. Which are the stocks where we need to invest or which we need to get into trading of those stocks. And those screeners is where the technical people get involved based upon the logic that is given to them. They provide the screeners for shortlisting of the stocks for investment and trading. So that's one of the area where technical involvement is required for development of screeners. So with that small brief background of investment and trading, let's move on to the market participants and the strategies. Now, strategies by themselves have no existence really unless they are catering to the needs of the market participants. So without the market participants, strategies do not have any meaning. It's not a theoretical science where you do the research just for the sake of it and come out with different theorems and axioms and theoretical principles. It's not the what strategy is. Strategy is basically a part of applied science, I can say. So for that, we need to first understand what is required, what is needed by the market participants. So what the most important thing that market participant needs is the accuracy of the data that they are dealing with. They need exact levels of prices. They need exact levels of volumes that gets traded. They need exact data about the open interest and things like that. Without that, our trading will not be successful. The accuracy is most important thing in the uh, trading or investment business. The next comes volume of data. When I talked about the screeners and when I talk about later about the strategies, it involves taking into consideration large amount of data that is required to be handled in decision making process. So thousands of data points in fundamental as well as technical area are required to be analyzed. So that is another uh, important aspect of investment and trading, which is required by market participants. And the next is the data analytics. We have to translate that data by applying appropriate algorithms and coming out with the proper heuristics, you may call it, or you may call it as a well-defined scientific process. But ultimately, the end result should be some action points that results out of this analytical action. So this uh, business logic gets translated using this data into an executable. So that's another requirement that market participants have. And the timely execution is important. I mean, when the opportunity comes, you should be able to execute it. You should be there to execute it immediately and take advantage of it. If there is a market fall and if you are a little late, then you end up losing a lot of investment because you have not sold the investment at the appropriate time. So the timely execution of the triggers that you generate through your strategies also is important. And last but not the least, the most important thing is the overcoming of emotions. Most of the times, those people who trade manually, they face a lot of dilemma when they are exiting with a loss. They are, always uh, they are likely to think that no, I will let me wait for some time. The markets will improve, and then I'll sell it at a appropriate price and things like that. And they keep on waiting, and that right moment doesn't come, and they finally end up making a lot of losses because of their fear of losing. So there is a greed and fear you would have heard about when hear the commentators about investment. There is a greed and there is a fear. These are the human emotions which cause problems, which hampers the decision making process of the human beings. So these are the needs of the market participants. So we you may ask, where does the strategy fit in this? So the strategy fits uh, in addressing all these needs. So before we see how strategy does that, let us first understand few basic concepts about the stock market. So I have listed out those points here. The most important, the first one is the fundamental analysis and technical analysis. You would hear this quite often when you are working on your strategies. Fundamental analysis we have touched upon briefly. It's basically the qualitative data that one gets on each company, and when that is analyzed for your decision making process, for investment decision making process. So that's part of the fundamental analysis. They don't really look at the charts and indicators and things like that. Whereas technical analysis is a branch where you look at the price and the volume data of the market, price and volume or price action data of each and every stock that you are interested in. You don't really look at what is happening in that company, what is happening in that sector, what are the government policies, etc. You you purely focus on what the charts are telling you, how the prices are moving along with the volume of that movement. So that is where the technical analysis comes into the picture. It involves studying of charts, studying of chart patterns. It involves studying of various indicators and oscillators. We will touch upon that briefly later on. But the technical analysis focuses on these aspects rather than the fundamental qualitative aspects of the company and its performance. The next item on my agenda is knowing about derivatives of the stock positions. So when I say derivatives, the underlying entity that gets traded is the stock. Suppose if you have Infosys as a stock that you want to buy or sell, that is the underlying stock which is considered as a cash position. So you deal in the cash position. If the Infosys price is say 1600 today, if you want to buy one stock of Infosys, you pay that 1600 through your trading account, and the deal happens, and that one stock, one unit of stock of Infosys gets credited to your demat account next day with the broker that you are trading with. So that's the cash, because the trading is happening in a cash. You exchange cash for those positions. You either sell the position that you have and get the cash, or you pay the cash and get the positions in your trading account. That is cash. The limitation of the cash trading is that you require a large amount of money to do that. Suppose if you want to buy 100 units of Infosys, so 1600 is the price into 100 is the quantity, that becomes 1.6 lakhs of rupees that you should have to buy 100 units of Infosys. Whereas the future is a derivative instrument where you can buy larger quantity of the stock at a lesser price. So uh, if I touch upon a little bit further on these futures, so as I said, future is a derivative instrument. Derivative instrument is entered into any time during the expiry, and it needs to be settled at the end of the expiry. So for example, in month of February, the expiry day is on 29th of February. And in the January, it was in the 25th of January. Expiry was on 25th of January. So between these two dates, there's a February expiry period, and you can enter into this future position uh, by uh, uh, by trading into derivative instrument called futures. Now, what is exactly meant by futures? Future is a contract between buyer and a seller. Buyer says that I will buy future Infosys at such and such price. Say, for example, I will buy today is the 1600 price. I say that I will buy it at uh, 1590 rupees. I will buy uh, Infosys futures, and for that I am paying you certain amount of money to book that contract, book that trade. And the seller agrees to that, and he accepts that premium that you have given to him, and he agrees to sell you the Infosys futures at the expiry day. So, and there is a lot size concept that governs the future. So for example, Infosys futures is 400. Minimum lot that you want have to buy for futures is 400. And 400 normally you would have to pay 1600 into 400. That's about 6.4 lakhs. But for buying it in the futures, buying it as a futures instrument, you need to pay lesser amount than that. So I will just take you to another website which talks about, yeah, this is a Zerodha website where I'm entering the input. Input is NFO. The product is futures. The symbol is INFI. And INFI, the expiry date is 29th February. That is the expiry date. And this is the part of the instrument name that I am buying. I want to buy 400 units, which is a lot size. And if I say add, it tells me how much margin I need to have in my trading account. So it is telling me that span margin plus exposure margin, you need not bother about this at this moment, but total margin required is 1,17,000. So instead of 6,40,000, even if you have 1,17,000, you can enter into this trade of futures, buying in few futures anytime before 29th February. And for that, you pay certain amount to the seller. that is called as a premium. So if I go take you to another website, here is a this website is from NAC. This is a uh, this website is giving me the option chain. So we'll touch upon this also later. I'm saying in fee. Yeah. So it is telling me, given me the option chain, and so today it is 1600. So actual the price is 1660. Today the prices is risen to 1660, and I can actually sell or buy these contracts 1650, 1660, 1670. Depending upon your view, you can buy that option also for Infosys. So that's how you enter into uh, different instruments in futures and options. We will touch upon options a little bit later in more detail, but it's sufficient to say that these are the two options, futures and options. They are the two derivative instruments used for trading. Advantage is that you can get into this trade with almost 1/5 of the amount that is required for the cash trading for the same quantity. So that is the advantage of futures. Of course, there is a risk also associated. If you end up incurring losses, your losses will be in multiples of that, because your quantity is also, instead of 100, you're buying and selling 400, which is a lot size. So that's in brief what is the cash and futures and options trades. So with that, now I move on to the contracts and open interest. So contract, as I said, is an agreement between buyers and sellers about the agreement, about the trade agreements, at what price and what quantity and what date I can buy that and the seller can sell that. So that contract is an agreement, and that agreement or contract remains open till expiry. At expiry, you have to settle that contract by taking the reverse trade. So if you have bought something in futures, you have to sell that position, reverse that trade, and you have to settle that. So till that time, the contract remains open, and that is called as the open interest. So open interest is nothing but the number of contracts that are open at any given time during the expiry. So that's what is open interest. It's also an important concept. While you're developing strategies, you will quite often come across open interest as a term, because a lot of strategies use open interest for making decisions uh, about the trades. So we just saw the option chain. So we'll touch upon that a little bit, and then we will move to options payoff. So I'll go back to this particular option chain. So why it is called a chain? So before that, I will just briefly touch upon what is call and what is put. So we saw that we are buying a stock and we are selling a stock in future. So that is simple buy and sell of a future instrument. But call is another type of agreement between buyer and seller. The buyer says that I will buy, say, this Infosys. Sorry, yeah.
Putting a chair.
Any doubts? I hear some.
तेरे सामने ही है दोपहर में आया था वही है क्या
Hello. Okay. I hope there is no doubt, etc. So a buyer says that I will buy it, Infosys at this price 1660, and for that, this is the last premium. This is the price. This is the premium that I have to pay for that right that you buy to the seller. When you give this premium to seller, and in return you get a right to buy a particular instrument at whatever strike that you have agreed upon. You have an option to say that no, I don't want to buy it, and you no, forget about the premium that you have paid. It goes, you know, you, that's a loss for you. That's the price that you pay for buying that right. Whereas seller gets this price, to he pockets this price because he is agreeing to sell you something. He has an obligation. He cannot back out from that. He has to sell at whatever price that is agreed upon. So that is the seller's responsibility. So there is a seller's obligation that he has to sell it. Buyer has a choice to ignore that. He has to opt, he can opt out of that agreement. So that's about the call. So you are buying a right to buy, and same thing about put. Put is nothing but a sell. So these are the put positions here. So put is the right to sell something, sell position at a certain premium. So here, if I'm a seller, if I want to sell, I say that I will buy a put here. Put meaning I have a right to sell Infosys at this price. For that, I am paying you this much price, and seller agrees that he will buy Infosys at this price because he is receiving this much premium upfront at the start of the contract. So why these two different views? If I'm a buyer, if I'm bullish on Infosys, I will say that I want to buy this 1660 call because I'm hoping that that price will go up to 1700, so almost 40 points. And by that, the call price also will increase by about 40 points there. So I will be earning 40 points because it has increased from 1660 to 1700. If I take out 1670 that I have paid as a premium for that call purchase, still I will make profit of 40 rupees that I have uh, gained here, minus 16 rupees. So that is about 24 rupees profit you will make. So if you are bullish, you will buy a call. Against that, if you are bearish, you think that Infosys is likely to fall from 1660 to 1600. So there is about loss of 60 rupees. So then you will say that I want to buy a put. I want to buy a right to sell Infosys at this price for which I am ready to pay 13 rupees. And later on, when it goes down really to 1600, I will gain 60 rupees. And out of that, even if I deduct 13 rupees that I premium that I'm paying, I still make about 47 rupees as a profit. So that is the view that buyer and a seller has, and accordingly he will either buy a call or buy a put. And if you are adventurous, you will take the position on the sell side. So if you are thinking that the Infosys is not going to go up, I will rather sell this 1660 price strike price call, and I will pocket this money because I'm sure that this is not going to go up, it will go down. So it will not appreciate, and whatever you have received is your profit. So that is the advantage of uh, options. You can buy and buy a call and buy a put, and here the margin required is still further less. Suppose here also the lot size is 400, but again if you are buying it, you're paying 16 rupees for a lot size of 14. So it's only 6,400 rupees roughly. So 6,400 rupees for a call, 1,17,000 for a future, and 6.4 lakh for a cash. So that is the difference between the trading in cash, in futures, and the options instrument. So you can leverage your position, your money that you have by entering into the derivatives positions differently. So that is the difference between call and oops. Any questions? Okay. So I'll touch upon this payoff later on. Payoff is nothing but based upon the movement of the underlying stock price, your gains from the options position changes, and that is depicted in form of a graphical chart or a plot. So that is called as a options payoff chart. So we'll see the actual live example of it. So that time it should be a little bit more clearer. About options again, I'd like to talk about ATM, OTM and ITM. Again, I'll go back to that nifty options chart. So here if you see, current market price of Infi is 1660. And if you see this line here, it is 1660. On the call side, above the 1660, the positions are marked yellow. And on the put side, positions below 1660 are marked yellow. So actually below in the sense they are physically below, but in the strike price wise, they are above. So all the strikes that are above 1660, the current price, they are called as in the money positions. Similarly, on the call side, all the strike prices which are below the current price are called in the money call positions. And uh, this line where the strike price is 1660, which is almost equal to current price of Infosys, that is called as a at the money price. So at the money is where the current price of the stock is equivalent to that strike, almost near to that strike. So therefore it is called as at the money. In the money is where the position is in the money. So for example, if I have position at 1670, which is a put position, and if the market ends, the Infosys price ends at 1660, then I stand to gain about 10 rupees from this difference. So this position has some intrinsic value in it, and therefore it is called as in the money. Similarly, for the call side, the position here 1650 is, if you have a position here and if you can sell it at 1660, you will stand to gain 10 rupees. So therefore this position is called as in the money position, in the money call position. So all these are in the money call positions, all these are in the money put positions, and all those are without any colors, they are called out of the money positions. That means at the expiry, they will all be turned to zero. So if you see here the expiry is, Nifty expiry is on Thursday, so just 2-3 days. So most of them have already started nearing zero on the put side here, and they have started nearing zero on the call side here. They have become fractions less than one. And as we approach the expiry, these prices also will slowly approach towards zero. They will end up finally up to 0.05 or something like that. So that is the concept of out of the money, at the money, and in the money. So you can read it further. Probably it will be difficult to understand in first session, but this is just an introduction about the concepts. So the next item is volatility. So what is volatility? So volatility is considered in two separate situations, scenarios. So one is the historical volatility. That means how Infosys has moved across the throughout the period for last 1 year or so, how the price movement has been. If it is very stagnant, has barely changed 100 points here and there throughout the year, it will be called as a less volatile stock. But if it is moving up and down like Adani stocks, it will be a high volatility stock. So that is historical volatility. Based on the fluctuation in the prices, historically, this historical volatility is determined, and that is indicated in the form of an index, which is called as a India VIX, INDIA VIX. VIX stands for volatility index. So that is the historical volatility. Other than that, there is IV, which is of options chain again. So here, if you see the top headings, this column here is a volatility. This is uh, I forgot what I stand for, unfortunately, but it's V stands for volatility. If I remember, I'll tell you what I stands for. Uh, Intrinsic volatility. It is intrinsic because it is determined by the market behavior. It is not determined by NSE, or it is not determined by any authority. It is determined by the market, the players in the market. If so, for example, if I go here back at the ATM level, you will see that the these two prices, ask and bid, there is a difference of about almost 55 basis points. This is 16.2 and this is 16.75. What it means is the buyer is ready to pay only 16.2 rupees, whereas seller wants 16.75 rupees. So this difference is a measure of volatility. If there is hardly any difference, so for example, if I go to another stock, say ITC, here if you see at the money strike, there is hardly any difference. It's very less volatile stock, 3.4 and 3.5. So here you would see the volatility is less as far as ITC is concerned. So IV is a indication of market determined volatility in the option prices. And that also tells us a lot whether what kind of position we need to take based upon the IV. So there are strategies which are based upon the IV values. Like I mentioned about OIs, there are strategies based upon open interest, OI. Similarly, people have developed strategies based on the IVs. So that's about the IVs, volatility. With that, I move on to indicators and oscillators. Before that, I will cover this margins because we have touched upon margin initially. So I'll go back to that particular screen. Yeah, this was Zerodha screen where we saw margin. Suppose if I want to see what is the margin required for ITC. So I enter the name here and I click on add. So it tells me the margin required is 188, 1,88,000. So depending upon different stocks, sorry, the total margin is 2,35,000. So depending upon the stocks, the margin that gets decided for different stock is also different, and that is determined by individual broking house based upon the SEBI guidelines. So if you visit different brokers, they may have different margin figures for each of the stocks, but roughly more or less it is same because they are finally determined using same set of guidelines, but nevertheless it is determined separately by these individual brokers. So this gives us a margin that we need to have in our broking account in order to trade in future or options instrument for that particular stock. So that's what is meant by the margin. In order to determine the lot size, quite many times this margin is used because this margin will determine how much position in terms of volume of the stock you can take for that particular stock. So for example, if I take it as roughly 2.5 lakh, and if you have capital worth say about 10 lakhs, then you will be able to sell 4 lots of 1600. The lot size of ITC is different. It is 1600. So I will be able to buy or sell 1600 into 4 lots. That's about 6400 quantity for ITC if I have got 10 lakhs. If I had to actually buy or sell 6400, I would have had to pay lot more money than what I am paying right now for futures trades. So this is the margin that we make use of while placing trades, determining the quantity of the trade. Now we come back to indicators and oscillators. Indicators and oscillators is a very important part of the technical analysis. So for that, I'll now take you to different site, which is Trading View. These are all free softwares. You can note them down and refer to these different websites later. It's a wealth of information there available. So if I'm looking at Bank Nifty as an instrument that I want to trade in, and there is an indicator column over here. So I have already added one indicator called EMA, exponentially moving average. You probably would have heard about moving averages and exponential moving average in your mathematics class sometime. So that's what is being used here as an indicator. And there are, so if I delete them right now, I have deleted one and now I will add it back. Indicators, I say here EMA. It shows me this moving average exponential. I click on that and it is already added in here. It has got added here. So I close this window of indicators. I already had this EMA 22 indicator. I now have added EMA 9 also. So these are two different averages of different periods. EMA 22 is nothing but the average, moving average, exponentially moving average of 22 candles, 22 candle periods. Each candle is of 5 minutes. So, and this EMA 9 is average of 9 candles. So the blue one is the, uh, let me check which one is what. Yeah, blue is EMA 9. So this blue is EMA 9, which is above EMA 22. It is not crossed below EMA 22 yet. First time it has crossed below this is at this point, and that is considered as a bearish signal, and people would buy a put over here at this crossover. And if you see after this, it has really gone below. So its price here was uh, price is shown here on the top when it crossed below. Its price is shown above as 46,453, and when it came down here, its price has become 46,348. So it has reduced from 443 to 348. So almost 100 points difference. So if your profit target is only 100 points, you would have closed the position here and made 100 points profit. Lot size of Bank Nifty is 15. So 15 into 100, you would have made 1500 rupees profit in how many candles? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 candles roughly. So in 10 5 minutes candle. So that is 50 minutes, less than 1 hour, you would have made about 100 into 15, that is 1500 rupees. So that's how people use these indicators for technical analysis. Now, I don't know anything about what are the conditions that are governing the bank nifty prices. Are there any new regulations coming in for banks? Are there any bad news items about the banks? Why it has fallen down? I just noticed that the indicator has turned bearish, unfavorable for Bank Nifty. It has gone below EMA 9. Shorter term moving average has gone below the longer term moving average, and therefore it warrants that I should take good position here and I make some amount of profit in there. You may not carry it for the whole day or the next week. Just in hour or so, you make certain profit and you exit the position. That's how the intraday strategy works. So this is the example of indicators. So similarly, there is another type of indicator, like say for example, uh, MACD, the famous MACD moving average. I'm just throwing you names, throwing some names at you, but you can read them later on once you get some time. So this indicator gets, this chart gets formed below the actual price action chart of that stock, and it tells us something more about the stock. It generates buy and sell signals, which now when you read about it, you will understand what they are. Just to give an example, what are different indicators and oscillators that one can use in the technical analysis. So that covers basically the basic concepts of the stock markets that I wanted to cover, that I wanted to touch upon before I move on to the next slides. So we had left our earlier slide understanding what are the market participants' requirement, what they need, and then how a strategy fits into it. So if I have to summarize the process, investor has a view. He has a view on, he or she has a view on expected market behavior in the future, whether market is likely to go down, likely to go up, or a stock is likely to go down or up based upon certain developments in the market, in the economy, in the world economy, in the different markets. Suppose war breaks out between Ukraine and Russia. So certainly, suddenly some markets get affected, and the companies which have business with them, they get affected, and people start selling into them. So those are the observations that market men are continuously following, and they develop a view. They develop a expected market behavior in the coming future, in the coming days. And it is not just a view like we have views or on many other matter, like we have views, all have views on cricket matches, for example. We have view on who should be the captain, who should be bowling first, who should be batting first, and how they should have played. You should have played steadily or you should have attacked, things like that. We have the views and we express those views and get into discussion with our colleagues and friends. But this view is not of that sort. It is basically a view based upon which they have to determine certain action plan. So they come out with a possible action plan in response to the market behavior in coming future. So that is the basic starting point. And what is the objective? You will say that obviously the objective is making money. You will be doing all this only to make money. But more important than that, the most important objective of any investor is or should be preserving the capital. The famous investor Warren Buffett and his colleague, they always keep preaching about this, that the first principle in investment is that you should be preserving your capital. You should not lose your capital. And the second principle of investing is that you should not forget your first principle, that you should not lose the capital. So that is the kind of importance that is given of holding on to your capital. You should not simply take, put entire your money on one single position, and if it turns bad, 50-60% of your capital will be wiped out, and it takes ages to build that capital again. So distribute your money in different strategies, in different amounts, so that you preserve your capital. So that is the first objective. So while developing strategies, you need to keep this point also in your mind while you are evaluating the results of your strategy. So we'll touch upon this point again later. The second point, the second objective obviously is making money. You should be making money out. Without that, there is no fun in doing all this. How much money? That is also important. If you are making only FD rates equivalent of money from your investments, there is no point in making those investments. You might as well invest in FDs and earn returns, FD rates, without getting into all these hassles of making strategy and investing in market. Simply put your investments in FD and earn simple fixed amount guaranteed returns from banks or relief bonds or RBI bonds or some such instruments. But if you want to earn something more than that, then stock market or investment is the area where you should look at. Of course, you need not expect all the time you will make 100% returns. Even if you are making 15-20% return, it is much more than what you would normally get from FD. So that is the third objective. And the last objective is at a reasonable risk. You should be prepared to take reasonable risk as well while doing these investments. Without risk, there is no uh, assurance of getting any returns. So you should evaluate your risk and the gain that you have from the investment and make your decisions. So typically people talk about risk to reward ratio. Risk to reward ratio should be 1:2. Your risk should be 1 and reward should be 2 times. If you are likely to lose 100 rupees, you should be in a position to make 200 rupees at least out of that strategy. Then it will be a risk to reward ratio of 1:2. So with this objective and this viewpoint that one has in their minds, you come out with an action plan, and that action plan is nothing but a schematic diagram of a strategy. So what is strategy now? We can summarize is it's a process and it's a product also. Process of generating that concept, generating the documented plan, implementing it in a software executable form, deploying it at a marketplace. What is meant by marketplace? You deploy that strategy at a place like AlgoBulls, for example. AlgoBulls executes your strategy day in and day out and uh, seamlessly executes those trades for you in your trading account without you even knowing about it. You can look at your trading account, see what positions have been taken, or you can look at the logs that are provided by AlgoBulls and get to know what trades are taken, how they are doing, etc. But you need not be there. You can finally look at the end of the day how it has fared. So that ensures that you are executing your strategy without any emotions. You are not there to interfere in the execution of the strategy. Once it is developed, tested properly, and you're reasonably sure about its result, let that strategy just run automatically and make you money. So that is the overall process of a strategy, and finally you make continuous improvement in that based on the outcome that you receive from that strategy time, every time from your executions. So this is a process and this is a product also, because the software executable that you develop and it gets deployed, that's a product as well. So that is what is in a nutshell a strategy is. With that, I have already talked about indicators. We talked about EMA crossover, but maybe I can touch upon this as well. This is a stochastic crossover strategy. Stochastic is another indicator which gets shown here at the bottom of the price action chart, and it gives certain crossover signals. Red line going above blue line or red line going below blue line. All these are different trade signals for traders to act upon. So along with this indicator and this price action, you determine your strategy actions. And what is a stochastic? A stochastic oscillator is a momentum indicator comparing a particular closing price of a security to a range of its prices over a certain period of time. I'm sure you wouldn't have understood anything out of it, but the purpose is now not to explain this, just to show you these kind of things are available in other softwares. For example, this particular definition is taken from this stochastic. So what is stochastic? So this definition is taken from here. So you refer to this particular website, investopedia.com. It gives you information about almost all the indicators and oscillators that one can think of, and be prepared with those indicators and oscillators for them to be used in your strategy. So this particular site tells you or gives you more information about different indicators. So while we are on different websites, this is another website, is screener.in. It's a site where it gives fundamental information. So some of you might be interested in knowing the fundamentals of the company. So this particular site gives you the fundamentals, uh, data points about the company. What is its ROCE, return on capital employed, or return on equity, that is ROE. What is the PEG ratio? What is the debt to equity ratio? What is, if I click on this quarter, it gives you quarterly data right from December 2020 to December 2023. What was the sales numbers? What was the operating profit numbers? What is the operating profit margin, OPM? So all this fundamental data is given in this particular site. Those who are interested can go through this site. Just wanted to touch on this as well, as far as the fundamental information is concerned. So we go back to my presentation now. So having talked about this crossovers as a strategy, you may be, the next presentation may talk about this as an example in developing a strategy based on different indicators and oscillators. Therefore, I thought I should just touch upon this as well. The option chain we have already talked about, so I will not go into detail. Next is this option strategy payoff chart. So these are the strike prices on the x-axis. Different strike prices. This is Nifty chart. This is for Nifty, and the position that I have taken is 21,600 call option and selling of 21,600 put option. And this generates into this payoff table, payoff chart. What it means is this triangle at the center is the region that is profitable for me as long as the price remains within this triangle. So right from almost 21,350 to 21,850, in this 500 point range, if this Nifty remains throughout till the expiry, I'm likely to end up making some profit. However, if it goes beyond this, beyond 21,350 or beyond 21,850, this is where the loss starts happening. So this is the zero line. Below zero line, once it goes, you end up making losses. Above the zero line, you end up making profits. So this is the payoff chart. It's very easy to actually plot this, create this. If time permits, sometime later I can explain that as well. But for now, it is sufficient to just get a pictorial understanding of it as to, this is some kind of representation of where I'm making profit, in which area I'm making profit, and where I'll start making losses for this particular position, selling of 21,600 CE and 600 PE. So for that position, this is the payoff chart. For different positions of option selling and buying, it will generate different payoff charts. So that's an interesting part of the study in technical analysis of studying of those payoff charts. So with that, I'll come to the last part, which is evaluation of a strategy. So you finally have developed a strategy. You have translated the conceptual understanding of the investor into an actionable plan in form of a executable strategy, and it gets deployed on an executable platform. Now, how will you evaluate it? Evaluation will be made in terms of the profits or loss that you make. If you're making less than 6%, it's not a good strategy because it is not even earning equivalent of FD returns. If it is earning anything above 15, it's good, it is reasonable, one can live with it. It's better than most of the other types of investment that common man uh, gets involved into. So that is in terms of profits and losses. In terms of risks, so where is the risk coming into the picture? I talked about fear. Now, when the strategy is running, even if it is an intraday strategy, you start that strategy early in the morning at about 9:15, and you start making huge losses by the middle of the day. By 12, by noon, you are incurring losses. Finally, it comes up. By the end of the day, you come into profit. But during the day, it had reached up to almost 50% losses. So that's a great amount of risk. And if you're actually watching it, executing, you might decide to close that strategy, stop that strategy. Jitna, whatever loss I made, that's enough. I don't want to incur more loss. So you may end up closing that strategy. So that is the kind of risk that one has to keep in mind while you are evaluating. So you have to evaluate when you do the back testing for a longer duration, for a month or 2 months or 6 months. You have to see what is the maximum loss that I had faced, on each of these days. Whether it was 10%, whether it was 40%, 50%. So lesser that risk, better will be the strategy. So that is the evaluation of the risk in that strategy. And what is consistency? Sometimes the strategy is making profits, 40% profit. Sometimes it is making 40% loss. So it is very inconsistent behavior. Why it is harmful? Suppose, on a day it makes profit, you are absent, you are not there present to start that strategy. You end up losing that opportunity of making profits. And by your bad luck, you start the strategy next day when it incurs 40% losses. So in terms of consistency also, it should make reasonably consistent profits for you to take advantage of it. Inconsistent or fluctuating returns will be harmful for the execution of that strategy. So these are the main three parameters based on which there are different parameters when each of these parameters gets evaluated finally. But this is the broad conceptual area where the evaluation is carried out. With that, I think I come to the end of my presentation. So the main theme is invest now for the future in all walks of life, not in just investment, in your studies, in your efforts. You invest in your efforts into this to reap benefits later. So invest now for the future. That's the theme that we have. And finally, I'm open to your questions, if any.
Okay, that was an incredible session. Thank you, sir. Uh, Learned a lot. So, audience, now the floor is open for you all. Feel free to post your queries in the chat section.
Can I see the chart myself or you read out?
So I'll be reading out. So
Okay.
here's question by Sean. Would you say that options are safer than cash and futures?
Yes, safer. If you are buying options, then it is much safer because your liability is limited only to the extent of the premium that you pay. So in that sense, it is quite safe. If you buy in cash, you can now entire amount, entire investment can be wiped out if that stock stock price reduces to zero. It doesn't happen normally that way, but still theoretically you can lose the entire amount. In futures also the same thing. The entire loss is incurred by you. Whatever investment you have made, it will be wiped out in that. Whereas in cash, in options, your investment is restricted only to the amount that you pay as a premium to buy that right of either buying or selling that instrument. So in that sense, it is quite safer. And amount involved is also less. So that is beneficial on one side, but on the other side, it is harmful also because what happens is people think that it is cheap and it is safe, and then they recklessly buy options without really studying them. And what happens? They end up, you know, wasting that entire premium that they have paid. They convert that into a loss. Of course, it is small amount, so they may be able to afford it. But who gains in this process? The seller who is selling you these options. He knows that that price will not go up. It is likely to get zeroed at the end of the expiry. And therefore, seller becomes the beneficiary in that process. But yes, to answer your question, options is safer. Your liability is limited.
So I hope that answers. Next, we have how far profits in stocks according to risk are better in comparison to options and futures.
No, sorry, say that again.
How far profits in stocks according to risk are better in comparison to options and futures.
How how part? What is that word?
How far, how far
How fast?
profits?
How fast? No, I mean, I will not say fast or slow. It will be the amount of profit or loss that you gain or incur loss. That will be different. Because in options, your gain also is limited. Your loss is also limited. Because when the underlying price increases by 100 points, your options increase only by 50 points. So that is the difference. So that is governed by the option Greeks, as they call it. You may read on that as well. So it reduces the profit. Quantum of the profit is reduced in options, whereas in cash, your amount itself is limited. So to that extent, your profits are limited, because in futures, your profits are the highest because you're taking leveraged positions. 4 times, 5 times of the cash, you can take the position. So to that extent, your profits are also 4, 5 times more as compared to the cash.
Okay. So next we have from Archit. how can we get CSV file of OHLC data of 1 minute time frame for options chart for past 5 to 6 years?
There are data providers who give that. Otherwise, even NAC site also. If I may go back to NAC site, this is the options data, but this is not 4 minute. This is as of the end of the day. So you can download this file for a day. So end of the day, you will get a file for the options. What is the end of day position for the different options, different strikes, and their premiums, etc., and their volatility also. But if you want 1 minute data, you have to get it from the data providers, and which calls for certain price to be paid for it.
So I think that answers Arthur. So next up we have what are the upper circuit in stocks, as now Paytm share price hit its upper circuit recently in many days and purchasing was not able to be done during market time.
Right. So upper circuit is the safety plug that is devised by SEBI. So whenever there is a lot of activity in the market in a particular scrape, when it suddenly rises or falls by a certain amount of percentage, it is different. That percentage is different for different categories of stocks. So stock like Paytm, if it rises by 20%, suddenly that circuit breaker will come into play, and there will be no buy trades that will be allowed beyond that price. And so there will be no trades because nobody will be willing to sell at that price. Everybody is wanting to buy it. So it stays there for some time till the volatility gets over. So next day when the circuit breakers are off, it will start resuming normal trade. So similarly on the downside also, if the prices fall suddenly, then the lower circuit comes into play. So that is a security feature from SEBI that is applied on all these trading instruments.
Oh, so another thing you were showing in session about MACD and stochastic strategies. So where
Mhm.
can one learn more about them?
So as I said, this is a website, Investopedia, and it will tell you what is stochastic oscillator, understanding of stochastic oscillator, and then its formula, how it is calculated. So the formula, and it gives the nomenclature also, what is C, what is H, and etc. So if you understand this, you will be able to understand what is stochastic, how it is calculated, and how it is used. So all those things are presented here. Examples of stochastic oscillator, its history. It gives some amount of history also, who developed it, why developed it, etc. The association with other
Okay.
indicators like RSI and stochastic and so on. So this is a huge amount of information available in all these websites. Yeah.
Okay. So Archit is saying, does AlgoBull provide 1 minute time frame data?
AlgoBulls provides 1 minute time frame data for its execution. So if you want to develop a strategy, we provide 1 minute data, but we don't provide 1 minute data for your own personal consumption per se. Yeah. Have
So
I answered the question?
yes, sir.
Yeah.
So any further questions from the audience? Okay. So I think no more questions. Thank you, sir,
Okay,
for
great.
leading us through an insightful workshop and addressing all the queries with such clarity and patience.
Sure, sure, sure. My pleasure.
Uh, And thank you to all the attendees for your active engagement. For those who wish to revisit or catch up any details, the session recording will be shared shortly. As we continue this journey, join us tomorrow at 9:30 p.m. for the pre-event webinar, where you will be told about how the competition will proceed and how to use the AlgoBulls platform. Thank you all. Thank you, sir.
Thank you. Thank you.